Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the financial world without putting you to sleep. Today we're diving into a report from the Peerless Option Income Wheel ETF, and let me tell you, it has got more options and strategies than a chess grandmaster. Alright, so this is basically a semi-annual report for the Peerless Option Income Wheel ETF, ticker wheel, covering the period from the 1st of April 2025 to the 30th of September 2025. Think of it as a financial checkup for this investment fund. Let's look at what this ETF was actually putting its money into. As of the 30th of September 2025, its biggest holding by far was United States Treasury bills, making up a whopping 84.0% of its total net assets. That is like putting almost all your eggs in the safest basket possible. After that, we see some exchange traded funds or ETFs. The iShares Biotechnology ETF was the next largest holding at 3.3%. Then there is the First American Government Obligations Fund, Class X at 2.8%, followed by the VanEck Oil Services ETF, and the iShares US Home Construction ETF, both at 2.1%. It is a mix, but heavily weighted towards those super safe government bills. Interestingly, one of the top 10 holdings, the Industrial Select Sector Spider Fund, actually shows a negative percentage of 0.1%. This usually means they sold a call option on it, and the value went up, so they're obligated to sell it potentially at a loss compared to the current market price. Don't worry too much about that small negative for now, it is part of their strategy, which we'll get to. Now for some headline numbers, the fund size at the end of September 2025 was about $18.4 million. Not exactly a giant in the ETF world, but a decent chunk of change. They had 31 holdings in total. The portfolio turnover rate was a very high 277%. High turnover means they're buying and selling positions quite frequently, which can sometimes lead to higher trading costs, but also potentially capture short-term market moves. Looking at the types of investments, US Treasury bills made up a huge 84.0% of their assets. Exchange-traded funds accounted for 12.8%, which aligns with our top holdings. Cash and cash equivalents were a small 0.035%, meaning they are pretty much fully invested. Now this is where things get spicy under other financial instruments. We see written call options at a flat 0% and written put options at a tiny negative 0.003%. This tells us they are actively using options. When you see written, it means the fund is selling these options, collecting a premium, and taking on an obligation. Let's dive deeper into these options. This is the schedule of written options, and it shows the fund sold a lot of them. Total written options had a notional amount of negative $62,275. They received premiums totaling $44,655. On the call option side, they sold options on things like the IPIT Series BS and P500 VIX, short-term futures ETN, and the iShares Biotechnology ETF. Remember, selling a call option means they are obligated to sell the underlying asset if its price goes above a certain point, called the exercise price. They collect a premium for this promise. They sold a lot more put options. These are obligations to buy an asset if its price falls below a certain level. They sold puts on everything from the ARK Innovation ETF to various sector ETFs like Energy, Healthcare, and Industrial Select Sector Spider Fund, and even broad market ETFs like Invesco QQ Trust Series 1. Selling puts is a way to generate income from premiums, and can also be a way to express a belief that a stock won't fall below a certain price, or even a willingness to buy that stock at that lower price, if it does. Looking at the statement of assets and liabilities as of the 30th of September 2025, the fund's investments were valued at over $18.3 million. They had a deposit at the broker for option contracts of over $134,000, which is basically collateral for those options they sold. Their total liabilities were about $73,000, and their net assets were just over $18.4 million. Now let's look at how the fund performed for the 6 months ending the 30th of September 2025. Total investment income was around $175,000, mostly from dividends and interest. Expenses were higher at about $72,000 for the investment advisory fee, though with some expense reimbursement, net expenses came in around $61,000. The most interesting part here is the realized and unrealized gain or loss. The fund had a net realized gain from investments of over $356,000. But get this, the net realized gain from written options contracts was a massive $582,000. This is where selling those options really paid off. They also had a significant unrealized gain on investments. Overall, the net realized and unrealized gain was over $1.7 million, leading to a net increase in net assets from operations of $1.8 million for just 6 months. That is a really strong performance. driven heavily by their options strategy. Looking at the statement of changes in net assets, you can see these gains really boosted the fund's value. The net increase from operations was over $1.8 million for the 6 months. They also had capital transactions, meaning shares were bought and sold, adding another nearly $7 million. Distributions to shareholders were also significant, over $930,000. The financial highlights section gives us a per share view for the 6 months ending the 30th of September 2025. The net asset value per S-share went from $18.5 to $19.94. The total return was 14.51%, which is pretty darn good for a 6-month period, especially considering the significant portion in safe treasury bills. The ratio of expenses to average net assets before any reimbursements was 1.09%. After reimbursement, it dropped to 0.93%. This shows the advisor is covering some costs, which is good for investors. And that high turnover we saw earlier, the portfolio turnover rate was 277%. This confirms they are actively trading within the fund. Now, these notes to the financial statements are important. They explain the details. For instance, the fund is a non-diversified series of Tidal Trust 2, and its investment objective is to seek current income. They value their securities using a few approaches. For listed stocks and ETFs, they use the last quoted sale price. For bonds, they use an evaluated mean of bid and ask prices. Options contracts are valued using the midpoint between their quoted bid and ask prices. This is pretty standard stuff. On the asset side, they have investments at value, deposit at broker for option contracts, dividends receivable, and cash. For liabilities, they have written option contracts at value and are payable to the advisor. When it comes to valuing their investments, they use a hierarchy based on how observable the prices are. Level 1 uses unadjusted quoted prices in active markets for identical assets. As of the 30th of September 2025, they had over $2.8 million in Level 1 assets, which were mostly their exchange-traded funds. Level 2 involves observable inputs that aren't direct quotes, like prices for similar instruments or yield curves. The vast majority of their investments, over $15.4 million worth, fell into Level 2. This was mainly their US Treasury bills, whose prices are readily observable but might not have a fully active market in the same way as a stock. Level 3 uses unobservable inputs, meaning they have to use their own assumptions. Thankfully, they had $0 in Level 3 assets, giving us confidence that their valuations are based on market data, not just guesses. The notes go into detail about their derivative instruments like options. They explain how buying and selling calls and puts works and the risks involved. Because they are selling options, they are taking on an obligation. If those options move against them, they can indeed lose money, but selling them also generates that premium income we saw. They mention an average notional amount for written options was a negative $8.3 million. This represents the total face value of the options they've sold that were open during the period, which helps show the scale of their options strategy. Looking back at the statement of operations, the net realized gain from written options contracts was a very significant $582,000, and the net change in unrealized appreciation on written options contracts was nearly $7,000. This confirms the options strategy was a big driver of their positive performance. Under commitments and other related party transactions, we see details about their investment advisory fee. The gross fee was 1.09%, but after a waiver by the advisor, it came down to 0.84%. This is a pretty common practice where the investment manager temporarily reduces their fee to make the fund more attractive. They also have a sub-advisor, Peerless Wealth LLC, which gets paid by the main advisor. This is a layered approach to managing the fund. The portfolio turnover rate is again mentioned here, confirming that active management approach. On the tax side, the fund has elected to be taxed as a regulated investment company, or RIC. This is important because it means they generally pass through income and gains to shareholders. Avoiding double taxation, they aim to distribute most of their taxable income and gains annually to meet these requirements. Looking at distributions, they paid out $930,000 from ordinary income for the period. Under principal investment risks, they highlight the option wheel strategy risk. This basically means their wheel strategy, where they sell puts and then calls, can impact their performance. If a stock falls below the put's strike price, they have to buy it. If it then rises above the call's strike price, they have to sell it, potentially limiting their gains. It is a trade-off. They also talk about derivatives risk, which is pretty straightforward. Using derivatives like options can be complex and lead to bigger losses or gains than just holding the underlying assets. They can also be volatile. And then there is counterparty risk. This relates to the risk that the other side of the option contract won't fulfill their obligation. Since many of these are cleared through a central clearinghouse, the risk is that if that clearinghouse or a member intermediary goes bankrupt, the fund could lose money. In terms of actual buying and selling of securities, excluding short-term stuff, they had purchases of over $16 million and sales of over $23 million for the 6 months. This again reinforces their active trading strategy. Finally, the net asset value per S-Hair ended the period at $19.94, up from $18.5 at the start of the 6 months. So, what is the takeaway here? The Peerless Option Income Wheel ETF, WEEL, had a very strong performance in this reporting period. Largely driven by its options strategy, they generated significant income and gains by selling put and call options, which offset some of the risks associated with their underlying investments. While they hold a large portion of their assets in safe US Treasury bills, their active use of options adds a layer of complexity, and as demonstrated here, can lead to impressive returns when the market moves in their favor. However, it is crucial to remember the risks. The option wheel strategy risk and derivatives risk mean that if the market moves significantly against their positions, they could face substantial losses. The high portfolio turnover also suggests they are actively managing positions, which can incur transaction costs. In conclusion, this fund seems to be executing its strategy effectively for this particular reporting period, delivering strong returns. But like any strategy involving options, it comes with inherent risks. Investors should understand that this is not a passive buy and hold approach. There is active management and strategy at play. What is your take on this ETF strategy and its results? Let me know in the comments below. If you found this deep dive valuable, please hit that like button and subscribe for more corporate financial breakdowns. And don't forget to join our Discord community, linked in the description for even more discussions. Thanks for watching, and I'll see you in the next video.